You know, if you have ever thrown like a massive, heavily advertised blockbuster party, you are intimately familiar with that sheer cold panic of realizing right as the guests are arriving that you basically forgot to finish building the venue.
Oh, absolutely. The worst feeling in the world.
Right. I mean, you spent a fortune on the marketing. The DJ is locked in, the catering is world class, the invitations were absolutely stunning, and the hype is completely off the charts. But then you stand there, looking around the property, and the horrific reality sets in.
Let me guess. No roof.
Exactly. There is literally no roof, the bathrooms are locked, and the main attraction you promised everyone is, quite literally, a fenced-off construction zone.
Yeah. And the fallout from that scenario is immediate. You cannot simply smile and hand your guests a complimentary glass of champagne to smooth it over. I mean, they drove out there, they paid for the ticket, and they expect the experience you sold them.
They want the party.
Right. When you failed to deliver the core infrastructure of the event, the reputational damage is just catastrophic. And the refunds you have to issue will honestly bankrupt the entire endeavor.
And usually that is just an embarrassing, albeit expensive story you tell your friends years later. You lick your wounds and move on. But when you are a multi-billion-dollar publicly traded cruise line, and that party is a massive, highly publicized deployment of floating resorts into the Caribbean to capture a specific high-spending demographic.
That missing roof is going to cost you.
Oh, it does not just cost you your pride. It costs you hundreds of millions of dollars in market capitalization in a matter of hours. The market's reaction is swift, it is unforgiving, and it leaves a permanent scar on the management team's credibility.
Which is really the core of what we are unpacking today. The stakes on this specific earnings call were as high as they get in corporate finance. I mean, you have a brand new CEO who has literally only been in the seat for 2 weeks, stepping up to the microphone to deliver the news.
2 weeks.
Yeah, 2 weeks. And you have one of the most aggressive activist investors in the world, Elliott Management, hovering over the company with a greater than 10% stake, actively demanding strategic changes in board seats.
Right.
And then on top of all that, you have a massive fundamental reset of financial expectations for the entire coming year.
Welcome to Talk Tickers. Today we are taking a deep dive into the highly anticipated fourth quarter 2025 and full-year earnings call for Norwegian Cruise Line Holdings, trading under the ticker NCLH. Let me just establish the tone for you right out of the gate.
Yeah, we need to set the stage here.
Definitely. Because if you are tuning in expecting a celebratory victory lap about the resurgence of global travel, you need to recalibrate your expectations right now. This was a sobering, cautious reality check about severe execution missteps.
The goal for our analysis today is to systematically dismantle the mechanics of what management themselves, on the public record, are calling a self-inflicted guidance miss. We are going to decode this new leadership's turnaround strategy, step by step.
And crucially, we need to separate the macro from the micro.
Exactly. We have to figure out if the underlying leisure consumer is actually weakening across the broader economy, or if this is, purely a company-specific operational failure. Is the tide going out for the entire travel industry, or did Norwegian simply steer their own ship directly into a sandbar while everyone else was navigating the deep water?
Let's get right into the results snapshot.
Yeah.
I want to lay out the fourth quarter 2025 headline numbers to establish the baseline of where this company was before the floor completely fell out. So revenue came in at $2.24 billion.
Okay.
That represents a $0.10 billion miss compared to Wall Street consensus estimates, though. I mean, it is still up 6% year over year.
Yeah, and a revenue miss of that size, while certainly not ideal, is rarely the catalyst for a total capitulation in the stock price. I mean, a 6% year over year growth rate in a highly mature, asset-heavy industry indicates that dollars are still, flowing through the door.
Right. We moved down the income statement to earnings. GAAP earnings per share came in at just 3 cents. Which is a steep, noticeable drop from the 52 cents they reported in the prior year.
Which sounds bad on the surface.
It does. However, when we look at adjusted EPS, which, strips out some of the one-time accounting noise and gives us a better look at operational cash flow generation, that number came in at 28 cents. That actually beat the street consensus by 2 cents.
Right.
Furthermore, their net yield for the quarter was up 3.8% on a constant currency basis.
I really want to pause on that yield metric because it is the absolute lifeblood of the cruise industry. For anyone modeling a cruise operator, net yield represents the revenue earned per passenger per day minus the direct costs of getting that passenger on the ship, like travel agent commissions or flight bundles.
It's the real pricing power.
Exactly. It is the purest measure of pricing power. An increase of nearly 4% in net yield suggests strong pricing leverage. If you stop reading the earnings release right there, the narrative seems perfectly fine.
Yeah, you have a slight top-line miss, a bottom-line beat, and expanding yields. You would assume the stock would trade flat, maybe drift up a point or two.
But then you turn the page to the forward guidance for the fiscal year 2026.
Oh, well.
And this is where the bottom entirely drops out. The market reaction was violently negative, and it all comes down to the erosion of future earnings power. Management came out and guided FY 2026 adjusted EPS to $2.38.
And what was the street modeling?
The street was modeling something between $2.55 and $2.57.
Wow.
Yeah. That is not a minor adjustment. That is a massive haircut to expectations that forces every single analyst on Wall Street to immediately rewrite their valuation models.
The EPS cut is painful, but the real trauma for institutional investors was hidden in the yield guidance, wasn't it?
Absolutely. They projected 2026 net yield to be a mere positive 0.4%. The street was banking on a 2.1% increase.
That's a huge miss.
It's agonizing. In a capital-intensive business, operating leverage is a double-edged sword. You have massive fixed costs, paying for the ships, the fuel, the crew, the debt service. Once you cover those fixed costs, every incremental dollar of yield drops straight to the bottom line.
But the reverse is also true.
Right. When your yield growth compresses from 2.1% down to 0.4%, your margin expansion just evaporates. You are essentially generating zero real pricing growth in an environment where inflation is, still a factor.
The market absorbed that yield forecast and hit the sell button with terrifying speed. We are looking at a brutal response during both the pre-market and the regular trading session. Around the window of the earnings call itself, the stock plummeted roughly 11%.
Just fell off a cliff.
Yeah. Looking at the official close-to-close reaction, shares fell from $24.79 down to $22.18. That is a 10.53% decline in a single day. And it wasn't just retail panic. I mean, the volume tells the real story here.
Oh, absolutely.
Over 37 million shares traded hands, which is significantly above their typical mid-30 million average.
High volume on a double-digit down day is the unmistakable footprint of institutional capitulation. Portfolio managers were dumping their positions because the company fundamentally broke their trust.
Right.
Management is asking the market to ignore the structural pricing weakness of the entire coming year and instead focus on a 2-cent beat in the rearview mirror. And investors flatly rejected that premise. Credibility is a fragile asset, and when you guide to a functionally flat yield year in a growing economy, you lose the benefit of the doubt.
So how does a company with highly desirable physical assets lose its grip on pricing power when discretionary spending is supposedly still healthy? This brings us to the core operational failure that management admitted to on this call. It connects directly back to that opening analogy about throwing a party without a venue.
Right, the missing roof.
Exactly. The genesis of this guidance shock stems directly from their Caribbean deployment strategy.
And the mechanics of this self-inflicted wound are fascinating from an operational perspective. Norwegian made a strategic, deliberate decision to push a massive 40% capacity increase into the Caribbean for the first quarter of 2026.
I really want to emphasize the scale of that move for you listening. A 40% increase in capacity in a single geographic region is a staggering amount of supply to dump onto the market all at once.
It really is.
You are suddenly asking your sales force to find thousands upon thousands of new customers for a specific destination in a very condensed time frame.
Well, the underlying logic wasn't inherently reckless, to be fair. The Caribbean is the foundational bedrock of the North American cruise industry. It offers a highly predictable operating environment, it historically delivers exceptional financial returns, and it serves as the perfect entry point for the new-to-cruise demographic.
Right, the people who have never sailed before.
Exactly. Management specifically wanted to target premium families. But to attract that specific high-value demographic, you need a marquee destination. The linchpin of this entire 40% capacity surge was supposed to be their private island in the Bahamas, Great Stirrup Cay.
And private islands have really become the most lucrative battleground in the modern cruise industry.
Oh, without a doubt.
Because it is a completely closed economic ecosystem. When a ship docks at a public port like Nassau or Cozumel, the passengers get off the boat and spend their money at local restaurants, independent tour operators, and local shops. The cruise line captures none of that.
Zero.
Right. But on a private island, the cruise line owns the entire infrastructure. They capture 100% of the food and beverage spend, the cabana rentals, the wave runner excursions, the zip lines. The margins on private island spend are astronomical compared to the rest of the itinerary.
You understand the economic incentive perfectly. They routed this massive fleet into the Caribbean, banking on the premise that premium families would pay a premium ticket price specifically to access the newly upgraded Great Stirrup Cay experience.
Well, there was a problem.
A catastrophic logistical disconnect. The island simply wasn't ready to handle the premium experience they were advertising.
They forgot the roof on the venue. They sold the tickets to the ultimate island getaway, but the main attraction was missing.
Precisely. Management pointed out that Phase 1 of the island's redevelopment was completed at the tail end of 2025. They finished the new pier, which allows ships to dock directly instead of using smaller tender boats, which, is a massive operational improvement.
Sure.
They built an expansive new pool, and they upgraded several guest amenities. The initial guest satisfaction scores for those specific elements have actually been positive.
Okay, so what went wrong?
However, the primary draw for the exact demographic they were targeting, the families with children, is the Great Tides water park. And that multi-million-dollar water park is not slated to open until the late summer of 2026.
So you have a massive influx of ships sailing throughout the entire first quarter, trying to sell premium price tickets to families based on the promise of a world-class private destination. But the crown jewel of that destination is essentially a hard-hat construction zone.
It's unbelievable.
The chief financial officer, Mark Kempa, was surprisingly blunt about this failure on the earnings call. He explicitly referred to the capacity increase as premature.
And let me tell you, when a CFO uses the word premature on a public earnings call, it is the sanitized corporate translation for a total failure of internal coordination.
Yeah, that's not a word you throw around lightly.
Right. This was not merely a construction delay caused by weather or supply chain issues. This revealed a profound structural breakdown in corporate communication. We are looking at a company paralyzed by deeply entrenched commercial silos.
Let's dissect the anatomy of that corporate failure. Because, how does a multi-billion-dollar logistics and hospitality company reposition an entire fleet of ships without the executives realizing that the destination isn't fully built?
It happens because the fundamental pillars of the commercial organization, revenue management, sales, marketing, and itinerary planning, were operating in complete isolation from one another.
So they weren't even talking.
Exactly. The itinerary planning department looked at a map, looked at the long-term strategic goals, and said, move the ships to the Caribbean to boost private island utilization. The marketing team received that directive and began running expensive national advertising campaigns.
Promoting a water park that didn't exist yet.
Right. But they executed this massive capacity shift without an integrated mathematical plan to actually absorb those thousands of extra cabins at a profitable price point.
The individual gears of the machine were turning at full speed, but they were not connected to the same engine. The CFO explicitly admitted that they did not sufficiently align these departments. They lacked a single, cohesive operating plan.
Yeah.
So what is the mathematical consequence of that misalignment when it finally hits the balance sheet?
The consequence is the total destruction of pricing power. Because they dumped 40% more supply into the market and the core product, the water park, wasn't ready to justify a premium price, they faced a terrifying reality as the sale dates approached. They had to sacrifice pricing just to get bodies into the cabins.
Because you can't sail empty.
You cannot sail a cruise ship empty. The fixed costs will bleed you dry. Consequently, in the first quarter of 2026, their net yields are expected to decline by approximately 1.6%.
I was looking at the operational metrics in the release, and there is a glaring paradox here. Yields are dropping by 1.6%, but their load factors, the metric that tracks how full the ships actually are up 200 basis points.
And that is the ultimate hollow victory in the hospitality business. The ships are fuller than they have been in recent memory, but the company is making less money per passenger. They are achieving that occupancy by aggressively discounting the base ticket price. This is what happens when your commercial apparatus fails. You induce demand through margin-crushing promotions rather than brand value. It keeps the lights on, but it destroys your profitability.
So the Caribbean deployment is a catastrophe of their own making. But we have to look at the broader map, because a 0.4% yield guidance for an entire 12-month period implies that this operational rot is not contained to a single geographic basin. I mean, it has to be spreading elsewhere, right?
Oh, the compounding errors absolutely bled into other critical high-margin markets. The most glaring example is their European deployment.
What happened to Europe?
Well, management originally modeled strong financial tailwinds in Europe for the summer of 2026. Europe is traditionally a massive revenue driver because the ticket prices are higher and the booking window is longer.
Sure, people plan those European trips way in advance.
Exactly. But they made a bizarre itinerary decision. They slashed their long, highly lucrative itineraries, the immersive 9 to 14-day cruises, by 50 to 60%.
50 to 60%, that's a huge cut.
It's massive.
Yeah.
And they replaced those long sailings with what the industry calls open-jaw itineraries.
Okay, we need to unpack the concept of an open-jaw itinerary for the listener, because this is where consumer psychology completely collides with corporate planning. An open-jaw cruise means the ship embarks in one city and disembarks in a completely different city.
Right.
For example, you might board the ship in Rome, sail for 7 days, and get off the ship in Athens.
And on a brochure, that sounds like a magnificent, sweeping European adventure. You get to see Italy, the Greek Isles, and end up in the shadow of the Acropolis.
But the reality of executing that vacation as a consumer is an absolute nightmare. The moment a family of 4 sits down at their computer to actually book the logistics for that trip, they hit a massive financial wall.
The flights?
The flights. Have you ever tried to book an international transatlantic one-way flight into Rome and a completely separate one-way flight out of Athens?
It's brutal.
The airline pricing algorithms punish you for it. It is not simply half the price of a round-trip ticket. Airlines charge an exorbitant premium for multi-city, cross-border flight paths. You are dealing with different airport taxes, complex routing, and zero round-trip discounting.
The friction is just immense. And the cruise line's itinerary planners seemingly ignored that friction completely. They pushed a massive volume of these open-jaw itineraries onto the market and immediately met a wall of consumer resistance.
Because it blew up their budgets.
Exactly. The booking pressure was instantaneous. Customers looked at the combined cost of the cruise ticket and the bizarre airline routing, realized it broke their vacation budget, and simply abandoned the booking process.
So to compensate for the fact that the flights were suddenly costing thousands of dollars more than the customer anticipated, the cruise line had to discount the actual cruise cabin just to keep the total vacation cost competitive.
Yes. Once again, they sacrificed their own yield to cover for poor strategic planning. Management openly admitted on the call that this was another unforced execution misstep, a total misalignment between deployment strategy and commercial reality.
And the hits keep coming, don't they?
They do. We have to factor in the competitive dynamics in Alaska.
Right.
Alaska is a premium market, but the operating season is incredibly short, essentially just the summer months. The entire cruise industry recognized the historical profitability of Alaska and decided to flood the zone. We are seeing a mid-single-digit capacity increase across all major operators in the region.
Which means a price war.
Inevitably. When everyone increases supply simultaneously in a short season, it triggers a localized pricing war. Everyone is fighting for the exact same demographic, which inherently suppresses yield growth.
And they also highlighted a sluggish rollout in their brand new home port of Philadelphia.
Yeah, establishing a new home port is logistically complex. You have to train local ground staff, establish new supply chains for provisioning the massive ships, and educate the local travel agent community to push the new product. It appears they underestimated the friction of that launch as well.
When you aggregate all these localized failures, the premature, unsupported Caribbean capacity dump, the disastrous shift to open-jaw European itineraries that alienated consumers, the industry-wide overcapacity in Alaska, and the operational stumbling block in Philadelphia, that grim, barely positive 0.4% yield guidance for the year suddenly makes perfect mathematical sense.
It does. Management explicitly stated that they are entering 2026 slightly behind the ideal booking curve.
And being behind the booking curve in the cruise industry is a uniquely terrifying position.
Right.
The business relies on long lead times. People book major vacations 6, 9, or 12 months in advance.
Right.
If you are behind the curve today, you cannot simply manufacture demand out of thin air tomorrow. You are forced to play a desperate game of catch-up, which inevitably leads to late-stage aggressive discounting to ensure the ships sail full. It is a downward spiral for profitability.
And this specific dynamic naturally leads us to evaluate the broader macroeconomic picture. Because when a company misses guidance this severely, the immediate instinct of the market is to ask if this is the canary in the coal mine for the global consumer.
Are these execution errors merely a convenient scapegoat, masking a darker truth? Is the consumer finally tapped out? Are people fundamentally pulling back on large discretionary leisure spending due to inflationary pressures or economic anxiety?
Well, the data points embedded in this very same earnings call suggest the answer to that question is a definitive no.
Interesting.
This is not a macro-level consumer demand crisis. The evidence refuting the tapped-out consumer narrative is sitting right inside Norwegian's own corporate portfolio. We have to analyze the performance of their luxury brands.
Oh, right, because Norwegian Cruise Line Holdings is a parent company. They operate the mass market core Norwegian brand, but they also own and operate two distinct high-end brands, Oceania Cruises and Regent Seven Seas.
Exactly. And the operational metrics coming out of those two luxury subsidiaries are painting a completely different, highly lucrative picture.
The contrast is genuinely night and day. Let's examine Oceania first.
Yep.
They recently executed a major strategic pivot by announcing a fleet-wide, adults-only policy.
A huge move.
Very huge. They deliberately chose to sharpen their positioning in the ultra-premium space, entirely removing the family dynamics in the onboard experience. The market response to that repositioning was explosive.
Just massive.
They recently opened bookings for their newest vessel, the Sonata. The first day of sales shattered internal records. Bookings were up a staggering 45% compared to the launch day of their previous ship, the Allura.
And a 45% year-over-year increase in opening day bookings for a multi-thousand-dollar luxury product completely invalidates the thesis that the consumer is broadly retreating. And that momentum is not isolated to a single new ship launch. Regent Seven Seas, their pinnacle luxury brand, where itineraries can easily cost tens of thousands of dollars, reported that their January bookings jumped 20% year over year. They are seeing robust, price-insensitive demand across their entire global destination portfolio.
I want to push back on this slightly, or, at least to explore the counter-argument for you. Is it possible that the ultra-wealthy consumer booking a Regent suite is simply immune to the macro pressures that are crushing the middle-class consumer booking the core Norwegian brand?
That's fair.
Could the luxury brands be a lagging indicator of economic health, just floating above the fray while the mass market collapses?
It is a valid hypothesis, but the internal commentary from management actively dismantles it. Management was incredibly deliberate during the Q&A portion of the call.
What did they say?
They insisted repeatedly that the booking weakness in the core Norwegian brand is not due to a lack of available vacationers or a sudden drop in middle-class travel budgets.
It's just their own fault.
Exactly. They are entering 2026 behind the curve entirely because their own commercial missteps, the open-jaw flights, the unfinished water park alienated the consumer. The demand for cruising exists across all wealth brackets. Norwegian simply fumbled the execution while trying to capture the mass market share.
So we have thoroughly diagnosed the illness affecting the core brand. Now we must turn our attention to the physician tasked with the cure.
The new CEO.
Yes, the new CEO who has stepped into this inferno with exactly 2 weeks of tenure. I cannot fathom the psychological weight of taking the corner office, auditing the commercial pipeline, and realizing your very first public act has to be slashing the full-year guidance and absorbing a double-digit stock drop.
It is the ultimate baptism by fire in public markets. However, the tone he struck on the call was not defensive or panicked. He arrived with a highly structured, unsentimental turnaround framework.
No vague promises.
No vague promises about synergy. He outlined 3 very specific mandates or jobs that he is executing immediately to stop the bleeding.
Let's analyze those mandates. Job 1 is focused squarely on execution and culture.
And this is where the new CEO took a sledgehammer to the legacy corporate structure.
He really did.
He did not mince words. He openly criticized the existing corporate environment, specifically calling out the crushing bureaucracy and the deeply entrenched siloed culture that led to the Caribbean and European disasters. He stated unequivocally that the organization lacked a one-team mentality.
The transparency is honestly refreshing. He essentially stood before Wall Street and said, the physical ships are beautiful, the destinations are sound, but the human machinery running the business is fundamentally broken.
To fix that broken machinery, he has already initiated a massive personnel overhaul. He has installed an almost entirely new executive team in the critical operational functions.
Who did they bring in?
Well, they brought in a new president of the core Norwegian Cruise Line brand back in December to focus purely on product delivery. They hired a new chief marketing officer. Crucially, they brought in a seasoned industry veteran to lead the revenue management division. And they poached a new head of technology from entirely outside the cruise industry to modernize their systems. He explicitly stated that this newly assembled team is operating under a burning platform sense of urgency.
A burning platform. The phrase burning platform is not subtle. It communicates to the rank-and-file employees that the current way of doing business is literally destroying the company. And if they do not radically change their behavior immediately, they will not survive.
Exactly.
That brings us to Job 2, efficiency and return on invested capital.
When a company is missing its yield targets, the only other lever it can pull to protect cash flow is cost reduction.
Sure.
Now, to be objective, the previous management regime actually performed reasonably well on raw cost controls in recent years. The company is currently modeling nearly 3 years of sub-inflationary cost growth. They are aggressively targeting over $300 million in structural savings.
That's significant.
It is. In fact, for the first quarter of 2026, their adjusted net cruise costs, excluding fuel, are projected to decrease by 0.8%.
But the critical nuance here is where they are extracting those savings. The new leadership team is moving the cost-cutting microscope away from the shipboard experience.
Because that would ruin the brand.
Exactly. They recognize that if you try to save money by degrading the quality of the food, reducing the entertainment options, or cutting the cabin steward staff, you will permanently damage the brand equity. Instead, they are pointing that microscope directly at onshore selling, general, and administrative expenses.
They are targeting the corporate bloat. The SG&A line item is where the bureaucracy lives. By flattening the management layers and eliminating redundant onshore roles, they reduce the fixed cost burden without the paying customer ever noticing a difference in their vacation quality.
Which makes sense. And that leads directly into Job 3, operational upside through technological integration.
This was probably the most glaring realization of the entire call for me. The company spent billions of dollars over the last decade building stunning, state-of-the-art physical ships, but they severely and inexplicably underinvested in the invisible infrastructure required to monetize those ships.
They neglected their customer-facing digital systems, their back-end booking interfaces, and most importantly, their revenue management algorithms.
It is institutional negligence. Management admitted that they only began investing in a modern, dynamic revenue management system last year. Yes. This new pricing engine only came online 6 to 8 weeks prior to this earnings call.
It's insane.
You simply cannot run a modern, yield-driven hospitality business without state-of-the-art pricing algorithms. Airlines and hotels have been using dynamic, real-time demand pricing for decades. Norwegian was trying to optimize a multi-billion-dollar global fleet using legacy methodology.
I have to severely challenge the viability of this turnaround timeline, though. As an investor looking at a stock that just dropped 10%, when I hear a CEO talk about transforming the culture and implementing sweeping enterprise technology across a sprawling, asset-heavy organization, red flags just go up everywhere.
Oh, yeah.
Those are inherently massive, slow-moving initiatives. You do not just flip a switch and suddenly erase a decade of siloed behavior. Software integration in a legacy company is notoriously plagued by delays and cost overruns.
Your skepticism is entirely justified, and to his credit, the CEO conceded that exact point. Because the cruise industry operates on such elongated booking curves, meaning passengers are locking in their 2026 and 2027 vacations right now based on current pricing, the tangible financial benefits of this new revenue management system will take a massive amount of time to materialize.
So it's not a quick fix.
Not at all. He explicitly warned the market that while they can execute the onshore SG&A cost cuts relatively quickly, the revenue side of the turnaround, the actual repair of the yield curve, will require extreme patience. The real fruits of this labor will not be visible on the income statement until 2027.
And this requires us to pull back and examine the broader financial ecosystem this company is operating within. Because this newly assembled executive team is not operating in a vacuum where they have endless time to tinker with pricing algorithms.
No, they're not.
There are immense, immediate, external pressures bearing down on them. We must discuss the elephant in the boardroom, the activist overhang.
Elliott Management.
Yes, Elliott Management is one of the most sophisticated, ruthless activist hedge funds in the world, and they have built a greater than 10% ownership stake in Norwegian. They do not deploy capital to be passive, patient observers, while a management team slowly attempts to fix corporate culture.
Definitely not. Activist investors of Elliott's caliber operate on a specific playbook. They agitate for immediate value creation. They pushed heavily for the initial leadership changes that brought this new CEO in, and they're actively demanding board seats to assert direct control over the strategic direction of the company.
It is a staggering dynamic that the new CEO, with literally 2 weeks on the job, is immediately packing his bags to embark on a 2-week institutional roadshow, specifically to face these shareholders and justify his existence.
Every single word spoken on this earnings call must be viewed through the lens of that Elliott dynamic.
So they were talking to Elliott, not just retail investors.
100%. The messaging was a highly orchestrated, direct plea to the capital markets, and specifically to Paul Singer's firm, for operational runway. Management was desperately trying to convince the activists that the foundational bones of the business are pristine.
Right.
They emphasized that the physical fleet is modern, the private island infrastructure is nearing completion, and the Oceania and Regent brands are generating record demand. They are arguing that the core asset is highly valuable, and it was simply the administrative execution that failed.
They are essentially pleading, give us 24 months to fix the plumbing. Please do not force a fire sale or tear down the house just as we are installing the new systems.
But Elliott will base their demands on the reality of the balance sheet, which brings us to a massive structural pressure point for any cruise operator, the debt load.
The leverage metrics require deep scrutiny. Net leverage is currently sitting at 5.2 times. In a world where interest rates are significantly higher than they were during the previous decade's cruise boom, carrying a debt load that is over 5 times your earnings is a precarious position.
It's heavy.
It is. The interest expense alone devours a massive portion of operating cash flow, restricting the CEO's ability to invest in new marketing or technology.
Management was quick to contextualize that 5.2x figure, noting that it is temporarily inflated by the capital expenditures associated with the delivery of new physical assets. The Norwegian Luna was delivered in March, and the ultra-luxury Seven Seas Prestige is scheduled to arrive in December.
Right. Buying ships isn't cheap.
Taking delivery of these multi-billion-dollar assets requires taking on the final tranches of debt associated with their construction. Management estimated that these 2 ships alone add about a quarter turn to their total leverage ratio. That ratio will naturally compress as those specific ships begin generating their own EBITDA and paying down their specific debt facilities.
They also attempted to soothe market fears regarding future capital demands. They highlighted their order book, noting they have 17 new ships scheduled for delivery through the year 2037. This secures their long-term capacity growth pipeline. However, they stressed that the near-term capital outlays required to maintain those orders over the next 24 months are relatively modest.
And that specific detail is vital for the activist perspective. It means the balance sheet is relatively protected from immediate catastrophic cash calls, while the operations team attempts to dig themselves out of the yield hole they dug in the Caribbean.
They have breathing room on the capex side.
Even if they don't have it on the earnings side.
Exactly. Finally, before we look at the trading implications, we cannot ignore the geopolitical environment. A cruise line is fundamentally a global logistics operation, constantly moving assets across international waters. There was significant discussion on the call regarding the escalating tensions in the Middle East and how insulated this turnaround plan is from sudden exogenous macro shocks.
The geopolitical risk profile is bifurcated. On the purely operational side, regarding where they actually sail the ships, they are entirely insulated for the time being. Management was explicit in stating that they have completely rerouted their fleets and are no longer sailing in any of the affected Middle Eastern regions.
Okay, so no ships in danger.
Right. There are 0 direct disruptions to their current passenger itineraries.
They can reroute the ships to avoid conflict zones, but they cannot escape the realities of the global commodities markets. The primary vulnerability is fuel pricing.
Fuel volatility remains a massive, uncontrollable tail risk for the entire industry. They disclose that they are using $670 per metric ton as their baseline assumption for their 2026 financial models.
What's the mitigation there?
The mitigating factor is their aggressive hedging program. They are currently 51% hedged for 2026, meaning they have locked in the price for over half of their expected fuel consumption, shielding them from sudden price spikes. They are also 27% hedged looking out to 2027. Furthermore, they are driving structural efficiencies in how they operate the vessels. They reduced their fuel consumption per capacity day by 6% last year, and they project an additional 3% efficiency gain this year.
So we have meticulously covered the operational failures, the cultural overhaul, the luxury demand signals, and the balance sheet pressures. Now it is time to formally shift our analytical tone. We are moving into the talk tickers. This is not financial advice segment.
Yes, let me make the parameters of this segment absolutely clear to the listener. Everything we're about to discuss is purely a theoretical exercise in applying the operational insights from the earnings call to the mechanics of the options and equity markets. We are analyzing market sentiment. This is absolutely not financial advice, and you should not execute trades based on a deep dive discussion.
With the disclaimers firmly in place, let's explore the theoretical applications. Pitch me your strategy. What is the first outrageous but plausible trade idea synthesized from the depths of this guidance miss?
I am structuring a trade that I'm calling the waterpark straddle.
The waterpark straddle. The name is fantastic. Walk me through the exact mechanics of how this would theoretically operate.
This is an aggressive, multi-leg option strategy designed to capitalize entirely on the specific chronological timeline that management laid out during the call.
Okay.
They explicitly conceded that the financial pain, the yield compression, is heavily front-loaded in the first half of 2026 due to the open-jaw European issues and the Caribbean discounting. However, they also provided a very specific inflection point.
The end of 2026.
Right. They stated that the fourth quarter of 2026 is when Great Stirrup Cay will finally be fully operational. The Great Tides water park will finally be open, the construction walls will come down, and they project that roughly 1/3 of their entire passenger base will be touching that private island during that specific quarter.
That is the moment they claim the pricing power returns and yields finally turn positive. So the theoretical trade involves fading the immediate near-term recovery and placing a highly leveraged bet on that specific Q4 inflection point.
Precisely. The first leg of the trade involves writing or selling near-term out-of-the-money call options expiring in the summer of 2026.
Okay, so you sell those calls.
By selling these calls, you are collecting upfront premium from retail investors who might be foolishly hoping for a miraculous, rapid V-shaped recovery in the stock price. We know from our analysis of the booking curve that a quick fix is mathematically impossible because the discounted cabins are already sold.
Right, the damage is done.
The summer earnings are going to be dragged down by the European itinerary friction.
You collect the premium from selling the summer calls, and you use that cash to fund the second leg of the trade.
You use that generated cash to finance the purchase of long-dated, out-of-the-money call options expiring in late Q4 2026 or early Q1 2027.
Oh, I see.
You are setting up a highly leveraged bet that the new CEO's cultural overhaul and the implementation of the new revenue management system actually begin to bear fruit at the exact moment the physical infrastructure of the water park comes online. You're timing the precise intersection where corporate execution finally catches up to the physical asset deployment.
It is an incredibly aggressive structure, but it maps perfectly to the stated operational timeline. Let me pitch you the second theoretical approach. I call this the execution isolation pair trade.
Okay, let's hear it.
This strategy is tailored for an institutional mindset that wants to strip away the noise of the global macroeconomy and strictly trade the specific corporate dysfunction we just spent an hour analyzing.
I like pair trades for neutralizing market risk. How are you constructing the legs?
You take a long position in a broader leisure and entertainment ETF. Let's use the Invesco Dynamic Leisure and Entertainment ETF, ticker PEJ, as our theoretical proxy.
PEJ.
Over the last trailing 12 months, PEJ was up 13.3%. This definitively proves our earlier point. The consumer is still spending aggressively on luxury, travel, dining, and experiences. The macroeconomic environment for leisure is highly constructive.
And Norwegian.
At the exact same time, Norwegian's stock was down 2.1% even before this massive earnings miss.
The divergence between the sector's performance and this specific company's performance is incredibly stark.
That divergence is the entire thesis. The theoretical trade is to go long the PEJ ETF and simultaneously short Norwegian Cruise Line Holdings. By doing this, you completely isolate the macro thesis. If a global recession hits, both assets drop, and the short position protects your long position. If the economy booms, the ETF rises. What you're purely profiting from is the proven, admitted internal execution risk of Norwegian.
Which we know is real.
We know definitively that they have severe commercial misalignment. We know they are entering 2026 behind the booking curve. We know that turning around a siloed corporate culture in a massive legacy maritime operator takes 12 to 18 months at minimum.
Yeah.
You are betting that the rising tide of global consumer spending will continue to lift the broader sector ETF, while the heavy anchor of Norwegian's internal bureaucracy keeps them perpetually lagging behind their peers.
It is a remarkably clean, elegant way to monetize the exact execution failure we have deconstructed today without exposing your portfolio to massive directional market risk.
To bring all of these threads together and briefly recap the core narrative we've explored, we are looking at an organization that possesses phenomenal, multi-billion-dollar physical assets and is experiencing incredibly strong demand at the ultra-luxury tier. However, they are being severely and entirely rightfully punished by the capital markets for amateur hour execution regarding the deployment and pricing of their core mass market brand.
They threw the party, they forgot to put the roof on the venue, and now the new management team has to spend the next 12 to 18 months apologizing to the guests, firing the contractors, and trying to build the roof in the pouring rain while an activist investor breathes down their neck.
That is the perfect summation of the crisis. But before we sign off, leave the listener with one final provocative thought. Give us a scenario to mull over that builds on everything we've analyzed today but looks around the next corner.
The ultimate wild card in this entire saga brings us right back to Elliott Management. Elliott is sitting on a massive, highly influential stake. Management has explicitly stated on the public record that the turnaround, specifically the repair of the yield curve through the new revenue management system, will require intense patience and will not truly manifest until 2027. The provocative question is this: does an aggressive activist investor with a history of demanding immediate returns wait patiently for 24 months for a newly appointed CEO to execute a soft culture shift? Or do they look at those massive 45% opening day booking jumps at Oceania and the 20% demand surges at Regent and forcefully push the board of directors to carve out and spin off the highly profitable, perfectly functioning luxury brands as a separate public entity to unlock immediate massive shareholder value?
Oh, man. A complete structural breakup of the company. Spin off the pristine luxury brands at a premium valuation and leave the core Norwegian brand behind to figure out his own mess with the water parks and the open-jaw flights.
It's possible.
That is a deeply fascinating, entirely plausible scenario given the players involved. Once again, a final reminder that nothing discussed here constitutes financial advice. Thank you for joining us for this Talk Tickers deep dive into the mechanics of corporate execution. We will be keeping a very close eye on how this turnaround attempts to navigate the storm, and we invite you to subscribe, analyze the data yourselves, and share your own theoretical trade ideas with us. Until next time.